So you thought the Bitcoin ETF was the main event? Well, that might have just been the opening act. Now, the big institutional money is hunting for its next target, and a fascinating new theory suggests it's pivoting to two, well, kind of unexpected contenders. Today, we're going to break down what's being called the Sol-XRP pivot and the incredible market mechanics that make it so compelling.
Okay, so to really understand what could happen next, we have to look back at the seismic shift that just happened. You see, the approval of spot Bitcoin ETFs wasn't just another product launch. No, this was the official opening of the floodgates. It gave all that institutional capital a regulated, familiar, and frankly, easy path right into the heart of crypto.
So, with Bitcoin now having that institutional stamp of approval, the biggest funds on the planet are all asking themselves the same simple question. Where do we go from here? The game has totally changed. That initial gold rush phase is done, and now they need a whole new playbook for what comes next.
And let's be clear, we're not talking about a trickle of cash here. We are talking billions with a B pouring into these Bitcoin products in record time. This wasn't just a trend, it was a tidal wave of capital that now needs a new place to go. And that makes the question of what's next incredibly high stakes.
This is where things get really interesting. A compelling new theory is starting to make the rounds, and it's catching on with a lot of market observers. And it's a thesis that isn't about hype or picking the next hot coin. Nope. This is all about understanding the fundamental mechanics of market impact.
They're calling it the Sol-XRP pivot. And the core idea is actually pretty straightforward. Institutions, right? They tested the waters with the absolute behemoth that is Bitcoin. Now that they have a foothold, the theory goes, they're going to turn their attention to assets like Solana and XRP. And the goal? To find a place where their capital can make a much, much bigger splash.
And here it is. This is the simple but really powerful idea at the heart of this whole thing. Look, technology, community, utility, all that stuff matters, for sure. But for this next wave of institutional ETFs, the single most critical factor might just be an asset's market cap, its size.
But why? Why does size matter so much? Well, it all comes down to the mechanics of what the source material here is calling the perfect trade. It's this scenario where an asset's smaller size actually becomes its biggest advantage when it comes to attracting huge new investments.
Let's use an analogy. Think of Bitcoin as a massive oil tanker. It takes an enormous amount of force, or in our case, capital, to change its direction even just a little bit. But by comparison, Solana and XRP, they're more like speedboats. The exact same amount of fuel, or capital, can make them move far more dramatically. They can really take off. And when you actually look at the scale, the difference is just stark. A $1 billion inflow into Bitcoin is, relatively speaking, a drop in the ocean. But that same $1 billion flowing into a potential Solana or XRP ETF, well, that would represent a huge percentage of their total market value, creating a way bigger price impact.
And it's precisely this huge difference in size that creates the perfect trade setup. It offers these big institutional funds the potential to generate some seriously outsized returns, simply by deploying their capital into a market that is far more sensitive to these big inflows.
You know, this kind of thinking is more than just some trading idea. It signals something really profound about the crypto market itself. We're watching it move beyond just pure speculation and into an era of structured, strategic investing. We're literally witnessing the maturation of an entire asset class in real time.
So what's the bottom line here? What does this all mean for the future? Well, first, it gives us a brand new lens to evaluate assets, not just on their tech, but on their ability to absorb capital. Second, it kind of gives us a potential roadmap for how large funds might approach crypto going forward. And finally, it's just a crystal clear sign that this market is getting a lot more complex and sophisticated.
And of course, I have to say it, and it's incredibly important, this is not financial advice. The whole point here isn't to tell you what to invest in, it's to give you a mental model, a framework for understanding the powerful forces that are shaping this market as we speak.
And all of this leaves us with one last fascinating question to think about. If this thesis holds true, if relative size really is the secret ingredient for the next big institutional trade, then what happens when the speedboats of today eventually become the tankers of tomorrow? Which assets will be next in line?